Hi, this is Aaron Hoy with Capstone Home Loans. Thanks for joining me today. Today, we're going to go over the different mortgage products. And for some of you, this might be more of a kind of like a refresher course. For others of you that are joining me today, this is all brand new to you. Either way, I think everyone will walk away with some information here today that you're going to be a little bit more empowered in your job. So first of all, I want to start off with a few life hacks. I don't know about you, but I'm always interested in learning new things, and especially life hacks. Whatever we can do to make our day a little easier. First of all, let's start off with, if you're trying to fix a bad sleep cycle, stop thinking about what you need to do to go to sleep. Instead, think about what you want to wake up every day. No naps, no set bedtime, just get out of bed at a fixed time. So I thought that was kind of neat. Also, every 5 mile per hour you drive over 60 mile per hour is like getting an additional 10 cents a gallon for gas. So if you're looking to get cheaper gas, well, start driving a little slower there. The other one here that I found was neat is, instead of buying oven mitts, try buying a pair of welder gloves from a hardware store. They protect against a much higher heat and are built sturdier and will last 10 times as long. I think I'm going to be doing that one here next time I go to the store. My wife always buys these like thin plastic ones, and they last for about 15 seconds, and then my hands are on fire. Of course, how long should you be hold on to a hot pan from the oven? Anyways, instead of going to dinner and a movie, go to the movie first and then dinner. That way you have something to talk about at dinner. So anyways, let's just get jumping. Let's jump into the course here, and let me go ahead and share my screen. Let's do that here. All right. Okay, so I don't need to share me again there. All right, so starting with, well, first of all, again, Capstone University is about you expanding your mortgage knowledge. So I started doing this class here. This is my second one, because I know that in this world that we live in, there's a lot of information out there, and I just want to kind of consolidate that and kind of educate my referral sources so they know more about this side of things. You don't necessarily have to be an expert, but what I'm trying to do is just educate you so that when you're talking to people, you have just better understanding of things. Well, let's start here on the next slide. The mortgage process. So you have your loan application, which can either be done face-to-face with me. It can be done on a Zoom call like this. Most of my clients do online applications, and then I give them a call and we go over the next steps. We can also do applications over the phone. So whatever is easier for our clients, I'm there to help out. We also have the pre-approval versus pre-qual versus credit approval. Used to be years ago when I first got in the industry that you would pre-qual, and that's just when you just looked at clients' income and their debt, just what they've told you, and you kind of figured out what roughly what they would be at on a debt to income ratio and a couple other things. It was really not clear and concise. So pre-approval is when we pull credit, we get income documentation from the borrower, like pay stubs, W-2s, tax returns, that sort of thing. And then from there, once we have all the information we need, we run it through an automated system, and it'll give us pre-approval. And then the file sent over to processing, which is done in-house with processing. That is the person who kind of preps the file and gets it ready for underwriting. The underwriter is the person that makes the final decision. And then once we have that loan approval, we'll resubmit for final approval if there's any conditions. And then usually within a few days after that, we'll have your closing or your funding. So I have another class that I did on the actual steps. So I'll have that available for you to take a look at on my website. So let's talk about credit. So there's the 4 C's of mortgage underwriting: capacity, credit, cash, and collateral. All those are the pillars of a mortgage. Without any of those, you really don't have a loan. So even if you have 3 of those are very strong, like yesterday, I had a client who had excellent credit, had a very good down payment, had extra in reserves, but unfortunately didn't have a long enough history being self-employed. And so we're going to have to probably wait a little longer until we can get him pre-approved. Now, let's talk about capacity. So analysis of borrower's income versus debt, ability to pay the mortgage, debt to income ratio, also known as DTI, credit report plus child support and alimony. So a lot of times people aren't thinking about those sort of things, that may be an additional thing that could harm them or affect their pre-approval. So it's important that we know that up front if they're paying any type of child support or alimony. 45% debt to income ratio is on average. It can actually go higher than that. With conventional financing, we can typically go up to 50%. However, in some cases, it is closer to 45. With conventional loans, things are constantly in flux. And what I mean by that is, depending on what the market's doing, Fannie and Freddie might either dial back or be more aggressive, just depending on conditions of the market. We've seen things kind of ease up a little bit, and then we've seen them kind of tighten up a little bit. We've seen them ease up again. Right now, things are fairly open. I'd say it's a little tighter than it was maybe right before before COVID hit. It seemed like lenders were a little bit more forgiving on things like debt to income ratio, and then income. So it's really important to show a 2-year history. That is probably one of the most important things about capacity is showing that you have a history in the same line of work. It doesn't have to be same job, same line of work. And sometimes that's not always black and white, and so we can work with that. But also the ability of showing that they have 3 years of work. And so that can be difficult, but if someone's working, say, for example, at Boeing or Amazon, we're going to assume that as long as the verification of employment that we receive from the employer states that they are going to be, they're likely to be employed, we're going to assume that they're going to have income moving forward, or that job. Now, the next part is credit. So the 4 C's of mortgage underwriting here. So we're talking about credit because credit is obviously a big part of getting pre-approved. The statistical prediction of a borrower's future payment likelihood. So that's based off of 35% is payment history. So making your mortgage payment or your auto payment, credit cards, paying that on time and not being 30 days late. You can actually be up to 29 days late, just not 30. So a lot of people don't know that. 30% of that is based off of your current loan and credit card debt. So really what that, in my mind, is how much available credit you have. So the more available credit, like on revolving, the better the score you have. And that's 30%, not quite 35, but it's a big chunk. So a lot of people are surprised when they go out and maybe they do some home improvements and use their credit card and they max it out, and then their credit score drops 20, 30 points, or sometimes even more, or they're surprised on how much of an impact that has. 15% is length of credit history. So it's good to keep your accounts open, not to close those. 10% of types of credit. So it's good to have a mixture of credit, like say mortgage versus installment loans, like an auto loan, and credit cards or lines of credit. And then lastly, new credit. So inquiries. So a lot of people get really worked up on inquiries, but it's really only about 10% of your credit. So as long as you're not going out and doing anything crazy, you should be fine. Also, when you are shopping for a mortgage, you get 30 days to look around. Excuse me, I have allergies. Yeah, this time of year in spring. The 4 C's of mortgage underwriting, which is cash. So cash in the deal, your down payments. The more that you put down, typically the better, but believe it or not, you can go 0 down in a lot of different ways, and we could talk more about that. Cash and reserve. So having money set aside in a reserve account, such as checking savings, stocks, bonds, annuities, IRAs, 401k, money markets, cash value in life, all those things are typically used as money that could be used for down payment and also for reserves. And reserves is just when you have a few months of mortgage payments set aside, just in case rainy day happens, which it does sometimes. And then also must source the cash in the last 60 days. So with that, we need to show a paper trail of the last 60 days. We use something called account check. Well, first of all, we can use 2 months of bank statements. But what we found is a lot of times clients will do like snippets or They'll just give us part of their statements. And so with Account Check, they log in one time, and for 60 days, or it's either 60 or 90 days, we will have the statements that we need from their bank or the credit union, and they didn't really have to do anything except log in once. And we get all the information. It's just recommended that people do that. With that being said, we can do bank statements too. It's just a new technology that we can utilize and make our clients' experience just easier. The next one is collateral. So the appraisal. Appraisal is based off of sales of comparable homes, location, size, condition, cost to rebuild, rental income options, and loan to value. So with the appraisal, it's almost every time that a client applies for a loan, either it be a purchase or a refinance, we're going to need an appraisal. There are exceptions to that, and we're starting to see that come up more often, which is called an appraisal waiver, PIW. That is based off of a lot of different factors, but the reality is we don't know if a client qualifies for an appraisal waiver until we get an application and we have a property identified. Once we have a property identified, then at that point we can then run it through an automated system, and it'll let us know if we'll get an appraisal waiver or not. This is only for conventional loans, by the way. VA, FHA, USDA, anything government, it's not going to work. It's only with the conventional, which obviously can be a real benefit on it in today's purchase market. The other thing here, I'm just going to briefly go over this, the mortgage regulation. As you can see, there's a lot of different agencies now involved. Some of these were around prior to the mortgage implosion that happened in 2008. Others were added on afterwards, like the Dodd-Frank. And with that being said, nowadays it's more regulated, and sometimes I think to the extreme, but then there's other things that have happened that I really feel like things have gotten better since we had the Great Recession, and there was a lot of good reform that happened. The one key thing too I'll talk about is kickbacks. It used to be something that was kind of almost, I don't know, standard is the right word to say, but I definitely saw that occur a lot more back in the early 2000s. And yeah, I don't see that as prevalent now, which is a good thing. So let's go to the next slide here, and we're going to talk about options. So there's Fannie Mae and Freddie, which is your conventional 3 to 5% down. It's a first-time home buyer, and they are under the median income limit for the county. They'll use 80% of that. They can come in as low as 3%, which is kind of a nice thing. Max loan limit in Snohomish, King, and Pierce County is $891,250. It's called a high conforming loan limit. We'll talk about that a little later. And then all other counties are $647,200. And then jumbo, that's a non-conforming. So it's not a Fannie or Freddie conventional loan. Typically with higher loan amounts with conventional loans, and it's 10% down, lower debt to income ratios. And sometimes it can be much lower, where you typically see 45, you may see 41, sometimes in the 30s, like 36. So really with the jumbo, it's more restrictive in a lot of ways. Higher credit score requirements. Typically, they won't look at anybody under 700. There's exceptions to that, but the interest rates go up quite a bit. FHA, now that's typically used for that borrower who may not have as great as credit. We can go as low as 550 for credit score with FHA. And by the way, with VA, with FHA though, at 550 to 580, they do have to come up with 10% down versus 3.5. But the max loan limit in Snohomish, King, and Pierce is $891,250. All other counties, it does vary. So if you're in if you focus on other counties other than those three counties, you want to check to make sure, or actually just have me check for you. So if you have a borrower that's looking to buy and they're going to be looking in these other counties, it might be much less than what you would expect. So like, for example, like Thurston County, Skagit, even Island County, have me check that because it's usually less. VA, now I happen to be certified as a specialist there with a VA, got that certification last year. I'm a veteran myself, and so I understand the product very well. It's 0 down for US service members, no private mortgage insurance. which is a fantastic option for veterans. USDA, not an option that I see very often. I'll briefly talk about that one, but honestly, it's very hard to qualify for that program now. And unless you have clients that are in very rural areas, it doesn't seem to be a very valid option. And then also the state bond. Now, the state bond is Washington State Housing Finance Commission. They actually will help you with your down payment. So when a borrower comes to me, we'll get them pre-approved on an FHA loan, because that's the program that works best with this in most cases. With that, they will gift you, well, not gift you, they'll give you 4% down of the purchase price. The borrower will have to pay that money back when they sell refinance later, but it's 0% interest, so that's kind of nice. But typically we see the interest rates quite a bit higher on that. Okay, and then let's go to the next one here, the next slide. So let's go into more details about Fannie Mae and Freddie Mac conventional loans. So that's about 70% of the loan volume is conventional. So it's what we do the most of. I would say that for me, I probably do a little less than that and do a little bit more on the VA side. I probably do about 50 to 60% conventional, and the rest is FHA, VA, and then the other programs out there. Typically, you're going to do fixed rates, but adjustable rate mortgages now are starting to make more sense because of interest rates going up as high as they have. It's not a big fit for everybody, but it's something we can start exploring more with. What's probably going to be the best options for them is a 7-year or a 10-year hybrid ARM, where it's fixed for 7 or 10 years, and then it adjusts. And then there's caps on there to keep it from going too crazy high. But usually those caps with the conventional products are about 5% from the start rate, where the government loans are typically less. The most common loan type, most standardized guidelines, it fits under the Federal Housing Finance Agency. So it's kind of like the parent company, you could say, of Fannie and Freddie. It used to be where Fannie and Freddie were on their own independently, but then with the mortgage imploding there in the 2008 period, they have come under the conservatorship of the government. The other part we talk about is that Fannie and Freddie are kind of like siblings fighting, but they're fighting for the business. And you'll see that with FHA, or I'm sorry, with Fannie, they'll have a certain guideline where Freddie Mac may not. And so sometimes I can get a client approved with Freddie, but not Fannie, or vice versa, just depending on the situation. So as a lender, I always look to explore both options if I run into an issue with one. So it's important that we do that. The other thing that we'll mention here is that the AAUS reviews our file against guidelines and evaluates overall risk by looking at credit and credit score, income, assets, down payment, types of jobs, borrowers, and estimated value of home. So it's going to take all that into account. Okay, so is there any questions you guys have right now for me? Okay, well, why don't we keep going here? Let's go into the quick history. So in the 1900s, the early 1900s, banks gave home loans the banks required 50% down for home loans. And then it was a 5-year amortization and of course, a very short term, and usually with a balloon payment. So they would have a big payment they'd have to pay. And in the Great Depression, 25% of the homeowners lost their homes to foreclosure. So the Great Recession was terrible, but the Great Depression was much worse. The other thing that we'll talk about too is the Federal Housing Association administration, not association, I need to correct that, was established in 1934. FHA started offering 10% down. So at the time, that was a big deal. All right, so let's go to the next one here. So now the next one here is Jumbo. Now, Jumbo, that is a program that we see more and more often. With Jumbo, we are seeing more people going that route just because the purchase prices are going up quite a bit from where they were at here previously, as you well know. And so the key thing is it's anything over $891,250 for Snohomish, King, and Pierce County. And then the other counties are $647,200. And again, I mentioned this a little bit earlier, but specific banks or investors, they make their own guidelines. So they're not under the Fannie Mae or Freddie Mac. So that's something to keep in mind. And then also the guidelines may vary widely from investor to investor as they are tougher than conventional. That is very true. So as I mentioned, debt to income ratio, credit score, sometimes appraisals are more scrutinized. Sometimes we need two appraisals. So it's always better if we can find a way to make it go conventional if we can, but if not, these are definitely options. And there's more varied loan types. So you'll see more often with this that ARMs make more sense, so adjustable rate mortgages. The other thing we'll talk about here is the conventional loan base is 647 nationwide. And as you can see, these other areas, they will allow you to go higher. So we happen to live in that area where it is higher than what the county or the country is, as a whole is seeing. The other part too is when you're looking at a borrower that wants to purchase a 1 unit, it's 891, 250. As you can see, 2, 3, 4 units. So like a triplex, fourplex, the loan limits are quite higher. Let's go into FHA real quick. FHA, it's insured by the Federal Housing Administration. It's popular with first-time home buyers or borrowers with credit challenges. It has more flexibility in that way. The minimum down is only 3.5%. And that's at 580 credit score. Again, at 550, we can go that low, but they're going to require 10% down. Higher debt to income ratio. There's upfront mortgage insurance at 1.75% that they have to finance in loans. So that's something to consider. And then there's monthly mortgage insurance of 0.85 with 3.5% down and 0.80 with 5% down. Typically, it's lower interest rates, so that helps offset things a little bit. The other thing too, at PMI, it's for the life of loan, where conventional, you can get out of it as early as 2 years. There's stricter health and safety standards. VA is kind of similar that way. Stricter condominium approval, so you want to make sure the condo is approved, and you can always check with me on that. The next slide here with FHA, they have a disaster area loans, a 2 or 3K, rehab loans, reverse mortgages, streamlined refis. We actually do the renovation loans, and we're seeing more interest because prices of homes have gone up so much. And that's something I actually like doing. Conventional also offers renovations called the home style. So if you're interested in that, the base loan amount nationwide is $426.80. So again, you might be surprised how low it is. So definitely check with us to make sure if you have a client that is in Snohomish, King or Pierce County, and then now they're looking, say, Thurston County, we want to make sure that the loan amount is still within that range. Let's see here. The other part, it just mentions here about $511,750 for Island County. So that's a good example of where it's not as low as 420, but not as high as the Snohomish, King, and Pierce. All right, so let's go to the next slide here. VA. Now, again, VA is my specialty. So VA is for anybody as a qualified U.S. veteran, active duty military, and some surviving spouses. So I recommend that when you talk to your veterans, to ask them, have you ever served in U.S. Armed Forces? So you know that they've been in the military, but they may not understand that they are considered a veteran. Like for myself, I was in the service between the two Gulf Wars. Technically, we were in wartime, and we were protecting certain areas in the Persian Gulf, but I never saw action. So a lot of people feel like, oh no, I don't qualify for VA because I wasn't fighting on the battlefield. But believe it or not, they probably do qualify. So it's always good to have them talk to me. I'll be able to walk them through it. We'll need their DD-214, which is their discharge document that they can use for us to get a certificate of eligibility, which will tell us exactly how much eligibility they have. The program was developed in 1944 by the GI Bill of Rights, so right at the end of World War II. It's guaranteed by the U.S. Department of Veteran Affairs. The VA's guarantee means the government will repay the lender a portion of VA loan if the borrower doesn't make payments. So it takes a risk off. VA loans have the lowest default rate, which is very true, and purchased loans only for primary residences. So they can't be used for investment or for vacation homes. However, if a veteran moves into a home and stays there for 12 months, they can then move out after 12 months and use it as a rental, and they can keep that VA loan for it. So it's kind of a neat thing that they can do. Really, you can do that with FHA and conventional too. There are stricter condominium requirements. This also applies to standalone condos. So if it's detached, it still has to be approved. So that is something to keep in mind. There is, again, no minimum credit score, but lenders do. So our company, we have the ability of either going down to 580 and in some cases 550. 100% financing is available, and that's typical. However, if the veteran is not collecting any disability, they're going to pay a funding fee, and it's 2.3% the first time, and then subsequent use is 3.6%. However, they put down 5%, it's 1.65. So they'll save a lot of money, and then 1.4% with 10% down. So, it's typical to see zero down, but you can also put down money. And that funding fee is waived if they're collecting disability, which it's not as hard as you would think. Funding fee can be finance, or even in some cases, the seller can pay it if you can somehow get them to do that. We must produce a certificate of eligibility. So that's an important thing. We want to do that up front. No loan limits on the program, but loan limit amount can affect pricing. So if we get in the higher amounts, you start getting above $1 million, you're going to see a little bit higher interest rates. It's a little higher risk. VA loans typically have the lowest interest rates. And myth, you can only have one VA loan at one time. Well, that is a myth, because you can actually have multiple. I've actually helped clients where they actually had 3 under their VA. And then just real quickly, we'll talk about USDA. USDA, it was a very great option in the early 2000s here in Western Washington when housing was cheaper. Now that housing is much more expensive, most of my clients don't qualify. Either they make too much money or the housing to debt ratio, which is 29% of the income, could go towards the housing payment. Most people are paying well above 29% nowadays. So it's usually not a very good fit. I think I did 1 or 2 USDA loans last year. So it's not something that we see a whole lot of. Yeah, I'm pretty sure it was like 1 or 2 out of like almost 100 loans. So it's not something that is really a valid option. However, it does come up in conversation, and sometimes clients will see something online. We'll talk about it. And if it makes sense, great. Eastern Washington, but that might work, or other states, but not here. And real quickly, the Washington State Housing Finance Commission, they have a grant where they will allow you to, again, help offset the down payment with a bond that they pay back later on. It's usually coupled with the FHA loan. So they give them 4%, the borrower, and then they have an extra 0.5% they can use towards their closing costs or to buy down the rate. It does create a zero down. The pricing is set by Washington State Housing Finance Commission. When I last looked here the other week, 6.25%, definitely an increase from what we've seen in a while. This isn't as popular a program as it was, and there's actually another option that we can talk about, and maybe in another Zoom class there, and that will be, it's called the Daisy Grow, and I'm more than happy to go over that, but that I think is a better option for most of our borrowers. And then that's about it. So here today, just wanted to kind of, again, go in a little bit more detail. Hopefully this gave you a little bit more ammo, but I'm always here for questions. So you can see, here's my contact info. Feel free to take your phone and take a picture of the QR code. That's my mobile app. You're able to, first of all, you can share this app with your clients. The other part on that is when clients download it, there's a great mortgage calculator, and it'll actually figure out PMI, if it's conventional loan, the funding fee of VA. It really is a great mortgage calculator, and you can upload documents directly into your loan file, safe and securely. Highly recommend it for you and for your clients. And then also, lastly, you're told when the client goes in there to upload documents or any activity, you're also made aware, so you know if they're active or not. So thank you again for your time today. Really appreciate it, and I'm excited to move forward here into 2022. I know we're already 4 months into it here practically, but I'm here as a resource. You can always call me. Again, VA is my number one niche, but I also work a lot with first-time home buyers and Yeah, I'm here to help. All right. Have a great rest of the day and take care.